Over my last year working for Roush Coleman Homes, a Lennar company, I've discovered several homeowners coming in that are first-time buyers are unfamiliar with a lot of the terminology that's used whenever it comes to financing. So today we're going to take some time to just kind of explain some of these terms and what they mean to you and how they affect the home buying process. First term I want to talk about is principal and interest. This is a lot of times what you're going to see advertised on a website or something like that. This is solely just the cost of the loan itself. There's some other costs that are incurred as well when you start buying a home that you may not be familiar with, and we're going to dig into that a little bit as well. Another term you may see is principal, interest, taxes, and insurance, PITI. That is really whenever you're starting to get into how much it's actually going to cost to own that home per month. That's principal, interest, taxes, and insurance. The taxes and insurance are things that are unavoidable with a home loan, and those will go into an escrow account that are going to be pulled out annually, but you're going to pay monthly on that to make sure there's enough money in that account to handle those taxes and insurance as they occur on an annual basis. Another term is debt to income. So this is what gets a lot of homeowners or potential homeowners whenever they start looking at a home, is they have a good credit score. They have good income, but they have a lot of debt. And that debt to income may not qualify them for one mortgage or another. So it may require a larger down payment to qualify, or, it just doesn't work out unless they pay off some of the debt. So that is one of the things to kind of keep in mind whenever you're looking at a home is how much debt do you have? Another term is going to be loan to value, LTV. So that is how much are you going to put down versus how much you're going to finance. So if you have an 80% loan to value, you need to put down 20% to meet that 80% that's needed for the loan. There are also several different loan types to keep in mind. There's a fixed rate and there's a adjustable rate mortgage. Adjustable rates typically give you a lower interest rate up front, but can adjust after a certain time frame. Like if it's a 5/1 ARM, it'll be locked in for 5 years with an adjustment every year after that. And there's some caps on that as well. I'm not a loan officer, but speaking with a qualified loan professional can really help dig into what those are. There's also like a 7/6 ARM that's locked in for 7 years and then can adjust every 6 months after that. Once again, those caps and all that would be something you'd want to discuss with a financial loan officer. Then you have some loan types, an FHA, that's just has criteria that they have to fit to offer that loan. A lot of those will be like a 3.5% down loan. And they give preferred interest rates. So that's a good starting off point for a lot of first-time home buyers. You also have a USDA Rural Development Loan that is offered by the United States Department of Agriculture for rural development. So that is a zero down loan product. So it requires zero down, but you can also do down payments on that as well. But that also is one of those things that helps you with the upfront cost of a loan. There's also a VA loan. So if you've served in the military and qualify for a VA loan, that's another zero down option. You also have conventional. Conventional rates can have as little as 3.5% to 5% down, and can go all the way up to as much down as you want to put. And there will typically be a cap at how little a company will write a mortgage for. But those are some common loan types that you're going to be talking about whenever you're looking at buying a home. Another term that I want to put in there, and that's PMI, that's private mortgage insurance. So that is a cost that's incurred if you have less than 20% equity in your home. That would require you to make an additional monthly payment just to ensure the financial institution's interest in that loan. Some other things to keep in mind is, what is your comfort payment? So you can qualify for a mortgage and be within a debt to income, but not be able to budget a monthly payment. So you need to know what your monthly comfort payment is, how much you could afford to live in the home. Another thing is buying power. So this is going to take that percentage and let you know what the maximum that you could afford is. I suggest, knowing what that number is and knowing, if that fits within your comfort level. Monthly payment, that's one of the things, how much do you want your monthly payment to be? So even though you can afford something, doesn't mean that, every home is going to justify that payment. So just know what those numbers look like for you as an individual. And know if there's any seller contribution. That's going to help offset some things like closing costs that will be involved with a loan. So there's certain costs involved with writing a loan, administrative filing fees, origination fees, prepaids like insurance and things like that come into closing cost. So knowing what those closing costs are and how much money you would have to have at the title office to close on that home. Incentives. So not all incentives are seller contributions. Some of those could be, an interest rate block. And if you get that interest rate block, is there any seller contribution that comes along with that to help out with closing costs? So those are just a couple of things I wanted to discuss today to familiarize yourself with what a loan process and some of the things that will be asked and discussed in front of you.